What's up? Today, Quanta Services, ticker PWR. If Eaton makes the electrical equipment, Quanta is the crew that actually goes out and installs it. Record backlog, monster growth, and one number in this report that should make you stop and squint. They report in 2 days. Quick disclaimer, not financial advice, purely education. Let's get into it. Section 1, the big picture. What does this company do, and why is Wall Street paying up for it? 5 numbers. Market cap, about $94 billion. Revenue last year, $28.5 billion, up 20%, that's fast for a construction company. Gross margin, 15%, remember that one, it's the whole bear case. Forward PE of 48. And a record backlog of $48.5 billion. So what is it? Quanta is North America's largest specialty infrastructure contractor. Plain English, when a utility needs a new power line, a substation, or underground pipe work, Quanta's crews show up and build it. 2 segments now: electric infrastructure and underground utility. 70% of revenue comes from utility and power customers. 2 tailwinds, both huge. 1. America's grid is old and needs rebuilding, that's a multi-year, non-optional spending cycle for utilities. 2. AI data centers need enormous new power, which means new substations and transmission lines. Both of those are literally Quanta's day job. The headwind? Thin margins, cost inflation, and finding enough skilled workers. The competition, by size. Mastech at about $28 billion, more diversified into telecom and pipelines. MYR Group at $7.5 billion, a century-old pure electrical contractor. And Dycom, Quanta does roughly 5.5 times Dycom's revenue. Quanta isn't just the leader here. It's several times bigger than anyone else. The money table, and it's genuinely impressive. Last quarter revenue, $7.87 billion, up 26%. Adjusted earnings per share, $2.68, up 50% from a year ago. But notice 2 things the report is careful about. GAAP earnings, the official accounting number, were only $1.45, because it includes deal and integration costs. And gross margin is still about 15%. And here's the tension, right up front. Trailing PE of 93 versus a peer average around 50 and 83% premium. Forward PE, 42% premium. EV to EBITDA, 82% premium. Every single metric says the same thing: you are paying a lot more for Quanta than for anyone else doing this work. Which is exactly why risk number 1 in this report isn't an accounting problem, it's the price. 48 times forward earnings leaves almost no room for a stumble. Risk 2, 15% gross margins are thin for an industrial company. Risk 3, if utilities pull back on spending, the whole engine slows. Section 2, the report card. April's quarter, and honestly, it was a banger. Revenue $7.87 billion, up 26%. Adjusted EPS of $2.68 versus $1.78 a year ago. Record backlog. Guidance raised. And management confidence, per the report, 5 out of 5. That's the highest score we've seen in this series. The takeaways. That record $48.5 billion backlog is the headline. Backlog just means work customers have already committed to that hasn't been done yet. It's a peek at future revenue. They raised full-year guidance to nearly $35 billion in revenue. And they reiterated a long-term target of 15 to 20% earnings growth all the way through 2030. One row in this table deserves a beat. Adjusted EPS up 50.6%. And backlog jumping from about $44 billion at year-end to $48.5. That's $4.5 billion in new committed work added in a single quarter. Whatever else you think about the price, the demand side of this business is not in question. But here's what analysts pushed back on. Can that 15% gross margin actually expand? Is the premium price justified? And a big one, they authorized $1 billion buyback while also committing to heavy factory spending. Those two compete for the same cash. And the kicker, JP Morgan downgraded the stock to neutral even after this beat. Great quarter, downgrade anyway. That tells you everything about the valuation debate. What's next is imminent. Q2 earnings, confirmed for July 30th, before market open. That is 2 days from now. Watch the backlog trend and any progress on the transformer factories, because that's the margin story we'll get to. Section 3, Red Flags. Hunting for accounting trouble and warning signs. 4 out of 10, lower is better, so this is moderate. 0 high severity issues, 2 medium ones. And notice how the report words the top risk, valuation/margin. The biggest concern with this company isn't fraud or debt. It's the sticker price. The scorecard is mostly 2s: revenue quality, insider transactions, accounting, transparency, all clean. No unusual insider selling was found, just routine stock vesting. The 2 flags, margin sustainability at 5 and debt and liquidity at 4. That's a clean bill of health on everything except profitability and price. The margin 5, explained. 15% gross margin trails a lot of industrial peers, even with 20% plus revenue growth. The bull case for fixing it rests entirely on a $500 to $700 million investment to build their own transformer factories, with results promised by late 2026. The report is blunt: that's an assumption, not a delivered result. On debt, $4.7 billion in notes is manageable, but it came from buying other companies. And here's the line I want you to notice. The report says valuation compression is, quote, not a red flag in the traditional accounting sense, but it's the single largest risk to shareholders. Translation: nothing here is broken. You're just paying a very full price for it. Section 4, The Moat. How hard is it for a rival to come take this business? 36 out of 50. Ahead of Mastech. Ahead of MYR Group on scale. And the report says the moat is expanding, but adds a pointed caveat: the premium valuation already prices a lot of that in. Head to head, and Quanta wins nearly every row. Scale, a 5, and the peers are at 3, 2, and 1, that's the widest gap in any moat table we've looked at. Cost advantages, brand, distribution, customer loyalty, all 4s. But be honest about the ones. Network effects score a 1, because contracting doesn't get better when more people use it. Data assets, a 2. This is a people and equipment business, not a tech platform. The real edge is scale, and here's why it matters practically. Only Quanta has enough skilled crews to bid on the biggest, most complex grid projects. And they're doing something clever, building their own transformer factories, which smaller rivals simply can't afford. That's using size to solve a margin problem. What could erode it? Mastech pushing into adjacent big project work. MYR Group's cheaper cost structure in its niche. And private equity-backed roll-ups chasing the same grid modernization money. When a tailwind is this obvious, everybody shows up for it. Section 5, The Price Tag. And for this stock, this is the section. Everything else has been good news. Here's the bill. Forward PE of 48 means you pay $48 today for every $1 of profit expected next year. EV to EBITDA of 40 is another way of measuring the same expensiveness, adjusted for debt. Versus peers, about an 80% premium. And the report's overall read is one word: no hedging, expensive. Look at the spread. Forward P, Quanta 48, Mastech 40, MYR Group 27. Trailing P, Quanta 93 versus MYR's 38. EV to EBITDA, 40 versus MYR's 18. Quanta is more than double MYR Group on that last one. Same industry. Same tailwind. Wildly different price. Now the fair counterargument, and the report makes it. Quanta's 26% revenue growth and roughly 29% earnings growth are the strongest in the group. Faster growth genuinely deserves a higher multiple. The report's phrasing is careful, that partially justifies the premium but does not eliminate it. So what earns the premium? Scale, backlog visibility, and being the leading name in the grid and data center theme. What argues against it? Jefferies cut its price target. JP Morgan downgraded. When the sell side starts trimming on a company posting record numbers, they're not arguing about the business. They're arguing about the price. 3 things to track, per the report. Backlog each quarter against that $48.5 billion record. Gross margin progress from the transformer investment. And the valuation gap versus MYR Group and Mastech. Does the premium hold or close? Section 6, Crystal Ball Math. A DCF, guess the cash a business makes for years ahead, translate it to today's dollars. And this section has the single most interesting number in the whole report. Here it is. The DCF intrinsic value, about $452. The analyst consensus target, 678 to 783. The street high, 940. And the current price is roughly 687 to 730. Did you catch that? The cash flow math lands below where the stock trades. That basically never lines up this way. The assumptions behind it. Revenue growth 10% in the bear case, 25% in the bull. Gross margin 14 to 18%, and that margin row is the single biggest swing factor between the two outcomes. WACC, the impatience rate, from 7.5% to 10%. Small changes here, huge changes in the answer. Side by side, and look at the asymmetry. The bear case is 34 to 38% below today's price. The base case is roughly flat, anywhere from -1 to +14%. Bull is up about 30%. Compare that to Eaton, where the bear case was only 9% down. Here, the downside case has real teeth. And the report says the quiet part out loud. That gap between a 452 DCF and a $700 stock price means the valuation today rests on the market continuing to pay a scarcity premium, not on the cash flow economics themselves. If sentiment toward infrastructure stocks cools, that's the risk. Great business, priced on enthusiasm. Section 7, the calendar. Dated events that actually move the stock. 7 catalysts tracked, 3 high confidence, and the nearest one is 2 days out. Next 3 months. July 30th earnings, before the open, the first checkpoint after that guidance raise and record backlog. The $1 billion buyback rolling out, which supports earnings per share but competes with factory spending for cash. And any new large data center contract wins, which the report honestly labels speculative, nice if they come, no harm if they don't. 12-month view. February brings full-year results and 2027 guidance, which tests that 15 to 20% long-term earnings target. And then the one that really matters, whether the 80% valuation premium versus MYR and Mastech holds up, or compresses toward the pack. That single question probably decides your return. Top 3, Q2 earnings on Thursday. Transformer capacity margin delivery, which underpins most of the bull case. And the backlog trajectory, the best forward indicator this business has. Section 8, who's driving the bus? 43 out of 60, the strongest management score in this series so far. CEO Duke Austin scores 4 out of 5. CFO Jayshree Desai, also 4. And here's a number that matters, the CEO owns 0.38% of the company, about $369 million of his own money. Scan the scorecard, CEO track record gets a perfect 5. He joined in 2001, took over in 2016, and grew this into the largest specialty contractor in North America. 4s on CFO credibility, guidance accuracy, dilution discipline, and shareholder communication. Compare that to Eaton's brand new CEO scoring a 3, a decade of receipts is worth something. The blemishes are about optics, not accounting. Media scrutiny over CEO pay and perks, private jet trips, social club fees, at a company running 15% gross margins. And that thin margin criticism itself, unresolved after years of revenue growth. Neither is a scandal, but the report flags them as worth monitoring. The verdict, long-term owners. A decade-long CEO tenure, targets stretching to 2030, and continued reinvestment in the business all point to people building for the long run, tempered, in the report's words, by governance and compensation optics that warrant watching. Section 9, Bull versus Bear. 8 rounds, 1 judge. Bull takes 5, Bear takes 3. But read the key: uncertainty, valuation, durability. The bear didn't lose because the business is weak. Let's see why. This is the main event. Bull, analyst targets of 678 to 783, with Truist as high as 940, real upside if the story delivers. Bear, 93 times trailing earnings, 40 times EV to EBITDA, 80% above peers, and a DCF pegging fair value at 452. Plus JP Morgan's downgrade. Both analysts are looking at the same company and arguing purely about price. Round 3, the business itself. Bull, diversified across 2 segments, riding a multi-decade grid rebuild. Bear lands a real punch here. Contracting is inherently low margin and bid-driven, and being the biggest doesn't automatically mean you can charge more. In a business where customers take bids, scale wins you the job, not always the profit. Round 5, management. Bull, Duke Austin's decade of consistent execution and reiterated long-term targets. There, the pay and perk scrutiny at a thin margin company raises questions about capital allocation culture. Words versus optics, you weigh it. And the judge's ruling is the sharpest sentence in this whole report. Bull wins because the growth, backlog, and secular tailwind are all well documented, while, quote, the bear case is mostly a valuation argument rather than a fundamental flaw. That's the entire stock in one line. Nothing's wrong with the company. The question is only what it's worth. Last section, the beginner cheat sheet. What does Quanta do? It builds and maintains the physical stuff that carries electricity, power lines, substations, underground pipe, and the wiring feeding data centers. Think of it as the specialized construction crew that utilities hire to build and fix the grid. That's genuinely the whole business. How it makes money: it signs contracts, often multi-year, with utilities and energy companies to build or repair infrastructure. Two segments: electric infrastructure for power lines and renewables, underground utility for gas, oil, and big power users. 70% of revenue comes from utility and power customers. Simple model: win contracts, do the work, collect. The report calls this the biggest yellow flag, and it doesn't soften it. 48 times next year's earnings versus MYR Group at 27 and Mastech at 40. You're paying up for size and leadership, which leaves less room for error if growth slows. And the final checklist, which does something the other reports in this series never did. For green checks: easy to understand, financially strong, growing, risks identifiable. One question mark on needing more research. And a red X and actual X on reasonably valued. Every other company we've covered got question marks at worst. This one gets a flat no on price. That's the summary of the entire report in one symbol. Let's land it. 5 things about Quanta Services. 1. It's the crew that builds America's power grid, and the biggest one by far. 2. A record $48.5 billion backlog of committed future work. 3. Margins are thin at 15%, and the fix depends on transformer factories that haven't delivered yet. 4. It trades roughly 80% above its peers on nearly every measure. 5. A DCF puts fair value near 452 while the stock trades around 700, so today's price leans on the market's enthusiasm, not the cash flow math. Nothing about the business looks broken. The whole debate is price. One more time: education, not financial advice. Do your own research and talk to a licensed advisor before risking real money. Like, subscribe, see you in the next one. Peace.